When a signal is formed from two consecutive periods, it's known as a double candlestick pattern. These often hint at upcoming trend reversals, but can also be used to identify continuations. Bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. A bearish engulfing arises when a bullish stick is then swallowed by a subsequent bearish one. So negative opinion may be forming. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak or slowdown of price movement, and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. Piercing line. The piercing line is also a two-stick pattern, made up of a long red candle, followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price, and the green candlestick's opening. It indicates a strong buying pressure, as the price is pushed up to or above the mid-price of the previous day. Dark cloud. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day's optimism. It comprises two candlesticks, a red candlestick which opens above the previous green body, and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. Harami. A harami is essentially a backwards engulfing pattern. A candlestick is followed by a much smaller one in the opposite direction. The name harami comes from the Japanese for pregnant, because some believe that the pattern resembles a pregnant person. In a bullish harami, a red candlestick is followed by a green one that is completely contained within the body of the previous candle. This is often taken as a sign that a downtrend may be ending. In a bearish harami, the opposite happens, a green candle followed by a smaller red one. In both cases, the size of the second stick is used to determine the strength of the signal, the smaller the better. If a harami is followed by a doji, the smallest possible candle body, then it's known as a harami cross. Tweezers. Tweezer patterns are two candlestick reversal patterns. This type of candlestick pattern is usually spotted after an extended uptrend or downtrend, indicating that a reversal will soon occur. In a tweezers pattern, two identical candlesticks in opposite directions appear after a bull or bear market. Tweezers are taken as a sign of an upcoming reversal. The second candle is the opposite color, but otherwise identical. So together, the two looks like a pair of tweezers. There are two types of tweezer patterns, the tweezer bottom and the tweezer top. The most effective tweezers have the following characteristics. The first candlestick is the same as the overall trend. If the price is moving up, then the first candle should be bullish. The second candlestick is opposite the overall trend. If the price is moving up, then the second candle should be bearish. The shadows of the candlesticks should be of equal, or near equal, length. Tweezer tops should have the same highs, while tweezer bottoms should have the same lows. Railroad track pattern. One of the best and most reliable candlestick patterns is the railroad track candlestick pattern. It is formed by two opposite candles. In this pattern, both the candles are similar in design, but one must bullish and other bearish. Below is the representation of a railroad track pattern. Since this pattern looks very identical to a railway track, it is given the name railway track candlestick pattern. Types of railway track patterns. There are two types of railway track pattern, namely, bullish railway track and bearish railway track. Bearish railway track pattern. In this pattern, the first candle is bullish, and the second candle is bearish. If we try reading the pattern, the market showed bullishness in the beginning but came right back down in the end. Bullish railway track pattern. This pattern is opposite to the bearish railway track pattern. Here, the first candle is bearish, and the second candle is bullish.